Okay, let's go ahead and go through the solution to the additional partnership liquidation practice questions. This is the first one, and basically I've just taken what was in the Word document and copied it and pasted to an Excel spreadsheet for ease of use. And what I've done is I've taken our initial trial balance here, and I've simply oriented it 90 degrees, so it's horizontal. And again, the ABC partnership wants to liquidate. A, B, and C share profits in a 20-50-30 ratio. And we're going to go through a sequence of transactions to go ahead and liquidate the partnership in steps. So, part A, prepare a schedule of safe payments, pay out cash as appropriate, assuming the partnership wants to hold back $10,000 against possible expenses. So over here, let's go ahead and make up our schedule of safe payments. And we're going to have partners A, B, and C, and their capital balances are 140, 240, and 180. And for the schedule of safe payments, the first thing we're going to do is we're going to assume that all of these non-cash assets are worthless. Those non-cash assets tally up to $540,000. So we're going to assume a $540,000 loss, and that loss is going to be borne by A, B, and C in that 20-50-30 ratio. So A is going to bear 20% of the $540,000. B is going to bear 50% of the $540,000. And C is going to bear 30% of that $540,000. We're also going to assume that there's a $10,000 holdback for possible additional expenses. Now, this could just as easily have been combined with that $540,000 loss, and we could have done the $550,000 in one step. But again, just nice to do this separately, just this one time. So A is going to bear 20% of that $10,000. B is going to bear 50% of that $10,000. And C is going to bear 30% of that $10,000. So after the loss on all of the non-cash assets, after this $10,000 of additional expenses, what are the balances that these people would have? Well, A would have a capital balance of $30,000. That's A's existing capital balance minus these two sort of pro forma or projected deductions. B is going to have a capital balance of negative $35,000. And C is going to have a capital balance of $15,000. Now we assume that B is personally insolvent, so again, ideally B would go ahead at this time and write a check for $35,000 to the partnership to make up for his or her deficit in their capital balance. Unfortunately, we're going to assume that B is not going to do that, and so B's deficit of $35,000 is going to be split between A and C in a 20-30 or 40-60 ratio. So we're going to go ahead and allocate B's deficit. So that deficit of $35,000, A is going to bear 40% of that, 20/50ths or 40/100ths. C is going to bear 60% of that. And so the balances, and that's going to go ahead and basically we're taking away $35,000 of deficit from B and allocating it to A and C. And so the final balances, oh no, C now has a deficit. So now we're going to have to go ahead and allocate C's deficit to A. And so the only person left with a positive capital balance is going to be A. And it would have been nice to do this at the outset just to give us sort of a roadmap for where we're going. look at what we've got here. We've got $50,000 in cash. We got $30,000 in liabilities. So we have $20,000 in cash above and beyond our liabilities. Of that $20,000, we want to hold back $10,000 for unforeseen expenses, which means we have $10,000 in safe cash. And we've just determined that if all of these horrible things come to pass, the only person with a positive capital balance is going to be A, and so A is going to get that $10,000. So we're going to go ahead and pay A $10,000. We take $10,000 out of the cash account, and that reduces A's capital balance. Okay, now let's go ahead and start going through some, and you know, it's up to you whether or not you bring these balances forward after every transaction. I'm not going to do that. I'm just going to go ahead and bring balances forward periodically. So we go ahead and write off the goodwill. Again, goodwill is not a separable asset. We can't sell it. So goodwill in liquidation, goodwill never has any value. So we're going to go ahead and write off goodwill. And so we're going to go ahead and take away the $50,000 in goodwill. And again, of that $50,000 loss, A is going to bear 20%, B is going to bear 50%, and C is going to bear 30%. And get that cleaned up for our next iteration. Next, the receivables are sold for $50,000. So we're going to go ahead and take in $50,000 in cash. And what are we doing? We're getting rid of our receivables. Now, we just sold $80,000 of receivables for $50,000. There's a $30,000 loss. And again, that $30,000 loss is going to be borne 20% by A, 50% by B, and 30% by C. Liquidation expenses of $5,000 are incurred. So we're going to go ahead and pay out $5,000. And again, that $5,000 expenditure, that expense comes out of the pockets of A, B, and C in their profit or loss sharing ratio. So A is going to bear 20% of that. B is going to bear 50% of that. C is going to bear 30% of that. And now we're going to go ahead and do our schedule of safe payments. So this would be an opportune time to go ahead and bring all of our balances forward. And basically I just summed up this column, and you know, it's a nice thing to go ahead and just confirm that the debit side of our trial balance equals the credit side of our trial balance. So this handy little blank column here, I'm just going to say this is going to be that plus that plus that plus that plus that minus that minus that. Shoot. That plus that plus that plus that plus that, that's my debit side. That plus that plus that plus that is my credit side. So debits equals credits. I'm happy that I haven't dropped any digits anywhere. And now let's go ahead and do our schedule of safe payments. Again, our current capital balances are like so, just copying down these values here. We go ahead and assume a complete loss on our remaining non-cash assets, and we're going to continue to hold back $10,000 against expenses. Now at this stage, we've got non-cash assets of $410,000, inventory plus property, plant, and equipment. Let's go ahead and tack on that $10,000 right here. So the combined loss in the non-cash assets plus the holdback for unforeseen expenses, $420,000 loss plus expenses. Let's put it that way. And again, that $420,000 loss is going to be borne 20% by A, 50% by B, and 30% by C. So after allocating the loss in the non-cash assets plus the unforeseen expenditures, what are the remaining capital balances? Well, A is going to have 29, B is still sitting on a deficit of 12,500, and C is going to have a positive balance of 28,500. So again, we have to allocate B's deficit. And again, that $12,500 deficit is going to be split between A and C in a 20 to 30 or 40-60, 40% versus 60% ratio. So 12,500 times 40% and 12,500 times 60%. Again, basically we've taken that $12,500 deficit and allocated it between the two other partners. The final balances, assuming all of these bad things happen, so take the balance after the initial allocation of the loss, add that allocation of B's deficit. A is going to end up with 24,000, B ends up with nothing, C ends up with $21,000, and so here's our schedule of safe payments. And again, look at where we stand. We got 85,000 in cash, we got $30,000 in liabilities. We got $55,000 above and beyond our liabilities. Of that $55,000, we want to hold back $10,000 for unforeseen expenses, which means we've got $45,000 to allocate, and we've just decided that $45,000 is going to be allocated $24,000 to A and $21,000 to B. So safe payments, we're going to go ahead and take away $45,000, and we're going to give $24,000 of that to A, reducing A's capital balance, and we're going to give $21,000 to B, to C, reducing C's capital balance. Okay, again, this business here with I want to reinforce, this business of allocating the pro forma loss and the pro forma B's deficit, those are suppositions. They are pro forma calculations. These are not actual transactions. We're just going through a worst case scenario. The only one of these that is the actual transaction is when we actually figure out how much cash gets paid to which of the partners. So we've made our safe payments. Let's go ahead and bring our balances forward just so we have a good clear space to start with. So our last balances forward was this row. So now we've got 40,000 in cash. We've got no receivables. We've still got 120,000 in inventory. We've still got 290 in property, plant, equipment. We've got no goodwill. We've still got our liabilities. And we've got the new capital balances, 89,000, 197.5, and 133.5. Okay, next, we're going to go ahead and sell our inventory for $100,000 and pay off our liabilities. So sell the inventory. We're going to take in $100,000. The inventory had a book value of $120, so we got a $20,000 loss. And again, that $20,000 loss is going to be borne 20% by A, 50% by B, and 30% by C. And we're going to pay off the liabilities. And here all we're doing is we're taking $30,000 out of our checking account and paying off the accounts payable. Another safe cash distribution. So again, we'll do the let's go ahead and bring our balances forward. Again, our last balance forward was this one, to which we added that and that. So again, we had a 40, we added 100 to get us up to 140, we took away 30 to get us down to 110. So let's go ahead and get our new capital balances. And again, what do we have left in the way of non-cash assets? All we have left now is our property, plant, and equipment. We're going to assume that the entire $290,000 of property, plant, and equipment is worthless, plus we want to hold back $8,000 against possible expenses. So we're going to allocate a $298,000 loss plus possible expenses. And the same as we've always done, that's going to be allocated 20% to partner A, 50% to partner B, and 30% to partner C. So what are the balances after that allocation? Well, A is still at a positive balance, B finally doesn't have a deficit, and C has a positive balance also. So assuming that the remaining non-cash assets are worthless, assuming there's $8,000 in future expenses, this is where the partner's final capital balances will end up, and so that's going to be what we pay out as safe payments. Now, what does this all add up to? We got that plus that plus that, $102,000. What does that $102,000 represent? Again, we've got $110,000 in cash. We have no liabilities, so we could pay out the entire $110,000, but we say, look, we want to hold back $8,000 of that just in case there's some additional expense or some additional liability that pops up. So we're going to go ahead and pay out $102,000, and that's going to be paid out. I'm just going to be lazy and copy that from the row down below. Okay, balances forward. Our last balances forward plus the changes. So let me move this stuff down a little bit. So where do we stand now? We've got $8,000 in cash, we've got $290,000 in property, plant, equipment, and we have these capital balances. And again, it wouldn't hurt to go ahead and check to make sure that our debits equal our credits. So we're keeping things in line here. What happens now? The property, plant, equipment is sold for $100,000. So we're going to have $100,000 coming in. The property, plant, equipment had a book value of $290,000, so we've got a $190,000 loss, and as always, that $190,000 loss is going to be split 20, 50, 30. Okay, finally the liquidation is completed and the remaining cash is paid out to the partners. So let's go ahead and get our balances forward. What have we got? We've got $108,000 in cash. We have no other assets. We have no liabilities. All we've got are the partners' capital balances. So as a final step, let me go ahead and scooch all this stuff up just to make a little bit more room. As a final step, we're going to go ahead and pay out the final balances. We're going to go ahead and pay out the $108,000, and we're going to give each of the partners their capital balance. So we're going to give $21,600 to partner A. We're going to give $54,000 to partner B. We're going to give $32,400 to partner C. And final. Just sort of dot all of our I's and cross all of our T's. After doing that, we've got zeros across the board for our final trial balance. So again, we've converted all of our non-cash assets to cash, paid off the liabilities, and paid out the capital balances to the partners.